AI is going to require investment. It's going to require investment in infrastructure. It's going to require more jobs. There's whole towns that are being built around the data center. So it's going to provide a big boom in so many ways that I think a lot of people aren't even thinking about.
Nate, it's maybe before your time. It may actually be a little bit before my time, too. Why am I playing this song?
I'm going to only make one guess because it's become a new thing. Yep, as you pan to it.
I chose Dean Martin today for the record album.
Hey, I went with good old Elton John, and I'm not going to sing his songs for you. Then I don't have my phone, so you got me beat.
I wouldn't want you to sing any song. Maybe a Britney Spears song I could see you belting out, but that would be about it.
Hey, I did my musical time growing up in the church in our local area.
Did you really?
Yeah, so I was the lead. I was Jonah of Jonah and the Whale as a little kid. Oh, there's some horrific videotapes that never need to come out again.
Oh, you've got to get a picture so we can put it on the website.
I will try and figure out if my mom still has them buried some way. But then it's going to be like a legit VHS that they, mass produced and killed like all the trees.
Have you ever seen those websites where like it's the professional picture and then when you roll over it, it's like a personal picture kind of thing in people's bios? I think we should get that with your choir boy outfit on.
There you go. Yes. Dressed up, jumping in and out of a whale.
Exactly. Can I also highlight, just real quick, because I know the listeners who are not seeing the video are super interested in this. I have something else in my background I want to talk about.
All right.
I have Austin Dillon's number 3 NASCAR from Richard Childress Racing. Why is that important? Well, it's the Toys for Tots wrap, like the actual wrap. So he doesn't drive the Toys for Tots car every race. There's a few races a season where he drives the Toys for Tots wrap. The next one's going to be the Kansas race. I think it's coming up, but I don't know when it is. But anyway, that's important to me. I put that up there too because I'm also on the board for Toys for Tots. So I got to go down to Richard Childress Racing a few weeks ago where we had our board meeting, and I actually got to see that car, take pictures with it. Like Austin Dillon signed the hood for a thing that we have at the Toys for Tots headquarters. It was a really cool trip, and I've never really been a huge NASCAR fan, but now I can say that having gone to their racing facility and seen all the Dale Earnhardt, because number 3, remember, was Dale Earnhardt's number, right? So it was fascinating to see. So now I have a favorite NASCAR driver. I've met him. I've actually been to a race where he's won down in Richmond Motor Speedway 2 years ago. And so that's a new addition up there.
Yeah, that's a permanent fixture if you ask me.
It's kind of cool.
Right? Yeah. It's something I've never done, but I've always wanted to go to one of the races and just kind of see, because it's a huge sporting event.
Yeah.
So,
well, this is really a not Ask Dave Anything episode. This is an Ask Me Anything episode. So
yeah, no, we're back for another AMA. Lot going on as always. We always like to try and answer questions that we're getting from listeners, from clients that we work with. And I think there's 3 kind of main topics that have kind of floated up over the past month since we did our last one. I know we did a quarterly review where we kind of avoided certain things, but as we dive into today's topics, I think the main ones are, first off, the overall market recovery. We'll get into that in detail, but also then too, alongside of it, I think is really important and kind of tied with it, inflation. What's going on with current inflation, future inflation.
Right.
And then finally, we can't do an episode without talking about AI,
it's great. I'll talk about it now because we're recording at 11 o'clock. I'm already out of tokens on Claude until like my 2 p.m. reset. So
April 20th. That's the new thing you got to watch is how many Claude tokens have I used in the day.
Exactly.
Well, I always let you choose first. So I guess I know you want, AI is going to be a big one, but I don't know. Is that where you want to start?
Let's do inflation. I've got a lot of thoughts about inflation, if that's cool. Do you want me to just kind of take off? So,
yeah, well, I guess the question that we got, or I think maybe let's just frame it, and then I'm going to let you run, is what's the update around the most recent inflation report? Let's just start there.
All right. So the March inflation came in at 3.3% annualized. There was an almost 1% increase in inflation just monthly. It was 0.9%. But that was the highest since May of 2024. So, okay, right? So we're talking about headline, some flashing chirons at the bottom of CNBC kind of thing, right?
Yep.
Because it's headline grabbing. It's headline grabbing because it's also up 2.4% since February. So that's a big 1 month jump, right?
Oh, yeah.
So again, flashy, scary flashing Chiron on CNBC, maybe even CNN or anything else like that. Political commentary grabs a hold of that. So you start to hear a lot about how it's just this big jump. But when you look into it, you have to recognize that energy is the driver of that. Period. End of story. That's it. Energy, right? It's gasoline up almost 19% year over year. It's energy overall up 12.5% year over year.
Which are huge jumps.
Huge jumps, right? But then, okay, here's another date for you, February 28th. What's important about February 28th? Well, that's when the war with Iran started, right? So this Iranian thing, the Straits of Hormuz being closed, the oil spike, none of that is news to anybody who's listening to this. But, I mean, that is it. So let's talk about core CPI, right? Because that strips all of the volatility of energy and food prices out. Okay. Annually up 2.6%. Okay.
Okay.
All right. Monthly up 20 basis points versus the 90 basis points of the overall. Okay.
0.2%.
Right. So now we start, let's bring inflation back down to a little bit more of a grounded reality and less of a news headline. Okay. Because core CPI, as you said, strips out both of those, the food and energy, and that actually came in below expectations, right? So there's all these professional guessers out there who get paid a lot of money to guess where things are going. So that's the synonymous with professional guessing is expectations. Okay, so I think that's the number that really nobody was or even is talking about. Okay, great, fine, Dave. You pull out energy and food, and that's a lot of people's monthly bills. So is it really relevant to be talking about? I'm not suggesting, well, I'm going to suggest something, but right at this second, I'm not suggesting that people shouldn't care or should be like, oh yeah, gasoline and food going up, no big deal, blah, 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 blah. But there's actually some categories that fell in March, and here they are. Medical care, personal care, used cars, all down. Okay, so those are definitely some everyday expenses that people have. Okay, so and rents, which are a big component of it, those also posted their smallest monthly increase since January of 2021.
Yeah.
Okay, so now we're starting to balance the scales of justice here, right? Okay, shelter was up 3% year over year and only 30 basis points monthly, and food was up 2.7% year over year, which is okay, kind of in line with, right? Okay, which and it was basically unchanged month over month. So we're back to, this is all about energy, right?
Yeah.
So I wanted to take a look back, and now I'm going to refer to some statistics here because I don't have these memorized. Let's look at the 25-year picture. Okay, so here's what's exploded in price over the past 25 years. Okay, inflation over the past 25 years has increased. This is going to sound shocking, okay? Has increased 93% over the past 25 years. So it's doubled.
Sure.
Right? Okay. All right. Here's what has increased more than that over a 25-year time horizon. Hospital services up 281%. College tuition and fees, don't get me going on that, 197%. College textbooks related, up 177%. Child care and nursery schools, up 160%. Medical care services up 150%-ish. Dave, that's Dave rounding. Housing up 111%. Food and beverage up 106%. Okay, what's gotten cheaper than that 98% increase over 25 years? What's gotten cheaper? TVs down 98%. Toys are down 74%. Computer software is down 73%. Cell phone services down 44%. Or minus, when I say down, minus 44%. Okay. Clothing is only up 1.5% over the past 25 years. And new cars are up 26% over the past 25 years. So what's the pattern here? Okay, the expensive categories are categories that have heavy regulation attached to it. Okay, the cheap categories have massive competition, technology, and transparent pricing. Right, it's pretty transparent how much a television costs.
Yeah.
Right. It's not so transparent how much a hospital stay costs. Right. So I found the pattern to be really interesting. Also interesting over the 25 years is what's happened with hourly wages. Okay. Hourly wages are up 131% over the past 25 years. So wages have outpaced inflation at up 93%, and nobody's mentioning that. So the key point, I think the narrative that inflation is destroying everything is lazy. I just think that's lazy analysis. And I think it really depends on what you as an individual person is buying and consuming.
Yeah.
And that's why we do this real financial planning and don't just make generic assumptions about things. So that said, okay, now for all my music fans out there, Panic at the Disco, okay, I don't think that there's a panic in the disco right now because the bond market doesn't seem to be panicking to me, okay? And if you look at the 10-year tips, break even, 2.36%. And that's just the bond market's best guess at the average inflation over the next decade, 10-year tips.
Yep, exactly.
Okay,
you can do the math.
Right. So it's sort of like when we were talking last episode about oil. What are the futures markets in oil? Think about this as the futures market for inflation expectations or professional guessing expectations. Okay? But it's a collective 6 billion people, 7 billion people on the planet, right? Kind of thing. 5-year tips, break even, 2.6%. Okay, so those are not panic numbers to me personally. I don't think they're panic numbers. And I think the bond market is saying that this is an energy spike that is going to be temporary in nature. Now, I don't know what's happened in the past 5 minutes with the ceasefire, but it changes every 5 minutes,
it does.
Right? Okay. So
no point.
All
right.
We can talk about it. But when a ceasefire was announced, it was interesting to see what happened, right? Because to me, that feeds into what are people's expectations about time now. So when a ceasefire gets announced and Brent crude drops 13% in a day, West Texas Intermediary drops 15% in a day, and now they're still above pre-conflict levels, which were about $70, right? But this thing trends and massively shifts in the right direction the minute there's any good news about this. So
Correct.
To me, that screams this is not a systemic problem. This is temporary. And we talked about this in the last episode about oil and everything. But look, if or when the Straits of Hormuz open up, I think we're going to see this energy spike massively reversing. And I just referenced back what happened that day, right? So again, there's no facts about the future, but the underlying core trend at 2.6% is I will use the term well-behaved and not crisis territory for inflation. So, all right, I'm wrapping this up, I promise.
No, you're good.
I told you I had a lot of inflation, right? Okay.
I'm just itching to get in.
Right. So I know you are. I have 20 more minutes. Okay. Okay, so what does this mean for your portfolio? Well, nothing different. Okay, I think people stick with the plan, right? I think every scary report is going to bring the same sort of visceral reaction. What should I be doing something? I think that's people's natural reaction when they see the flashing chyron at the bottom of the screen. And I think people should be careful about being sold expensive inflation protection products right now based on fear selling, because I think there's some of that's I mean, I haven't seen it, we don't do it, but I'm sure it's happening, right? I mean, been in the industry for 25 years, seen some crazy stuff, right? So I'm sure there are like, if people are concerned about inflation, let's create this product, right? And that product may fill an emotional need right now in the short term, but like fast forward, you see what the inflation expectations are based on the tips. Like, do you really need to be doing something
correct
in your portfolio that can be
pricey, are you
actually
hedging?
Right? Or giving up liquidity or anything like right? What risk are you hedging? Perfect. So, look, I'm going to come back to the broken record. If you've got 12 to 18 months of cash reserve, you probably don't need to do anything. Maintain perspective on possibility versus probability, because I think possibility is one thing, probability is another. And I refer back to what are the tips, inflation expectations, what's core right now is all well behaved. Like the probability is, and also based on a 13, 15% drop in oil, the minute there's a shred of good news.
Yeah.
The probability of this being a long-term problem are low, Dave Armstrong opinion, right? Disclaimer.
Yeah.
Okay. Past performance is not
indicative.
All of that stuff, right? But that is my opinion. I may be wrong. I just don't think it's probable that I'm wrong. So again, to people listening who have portfolios, like, don't blow up a good plan over something that's possible and not probable. Now, here's the chance for you. This is my lead in for you, right? Here's my Dave brings it home. Okay. 3.3% headline, 2.6% core, below forecast, let's remember. Energy spikes from a conflict that I believe is in a retreat rather than an escalation. But again, when this is done recording, let's go outside and we may see that there's, missiles in the air again. The bond pricing expectations, 2.4% for inflation. I think that inflation is a category story and not an everything story. If you look at the past 25 years of history, don't let the headlines scare you into making a bad decision. Have your cash reserves, stick with the plan, discipline over drama, jump in.
There's only one thing you need to know about inflation, and it's based around expectations. Mm-hmm. And you just talked a lot about expectations. And I think, again, the big expectation out there is the Federal Reserve's target. Federal Reserve target is 2% inflation. Mm-hmm. Inflation is above that target. There's no way around it. This is not inflation that we want. We want inflation to come down. And for so long, I think inflation was zero. For right after the financial crisis, basically all the way up until COVID pandemic, inflation was basically zero, regardless of categories. I mean, I shouldn't say that, but broadly it was at zero. There were categories that did better or worse from an inflation standpoint than others. But if the market's expecting it, that's not a bad thing. That's exactly what I want. The market doesn't like surprise. So if the market is expecting above 2% inflation at 2.6, who cares if it comes in at 2.6? Yeah. That's exactly what should happen. I think what's interesting when you broke it out by the categories, the ones that have seen the highest inflation growth are all service driven. As people get paid more, that's the kind of inflation that you see. Mm-hmm. All the goods, it just gets easier to manufacture them, especially in the technology space. Right. Tech was a new thing 25 years ago, but it's just gotten more efficient over time. It becomes cheaper to produce. Global trade helps with that as well as we become a more integrated society. Mm-hmm. But the places where you see a lot of inflation, medical services, childcare, those are very human. Yeah, those are all very human-driven industries. Mm-hmm. And that's where the wage growth came from. Wage growth is coming as people are getting more highly compensated. But unfortunately, that means we have to pay their salaries because we use the service. It's a big circle. Right. And I think, again, when you look at it, too, it comes down inflation at the Fed. And then what is the Fed going to do about it? We're scarred, man. We're scarred from the COVID pandemic. Inflation at 9% in a calendar year killed people. Yeah. And it killed people's psyche. I think, again, to your point around the fear, right now people are really scared of an inflationary bout. Well, inflation's going to go up. If the Strait of Hormuz remains closed, inflation will go up. It's going to be stickier. But there's other categories that hopefully can come down to help make it more sustainable. Right. It's not inflation everywhere like what we saw in the COVID pandemic. It's going to be higher inflation, but inflation is a good thing. Right. Because I just said it. That means people are getting paid more in all those services. Yeah. You can't have an economy with 0% inflation because then you're going to have no growth, basically. True. But here's something else about energy, too. This is just a perspective. But if 20% of the world's oil supply has been cut off, essentially, right? Mm-hmm. And everybody's screaming like, what's going to happen? Open up the straits. And oil stayed at $100-ish, right? What's going to happen when it opens? Because if the world's oil supply kept supply and demand at $100 a barrel, and now all of a sudden all of those tankers get unlocked and start coming onto the world market, what's going to happen to the price of oil? Now, here's something that listeners should keep in mind. Do you remember back in COVID when oil was literally worthless? I think it traded negative. It traded negative, and people kind of forget that. And that's what happens when you have some sort of like, so like when people say like, what are the chances that oil goes to zero? I don't know what the chances are right now, but historically it's happened. Yeah. Right now, I know that was an anomaly, and people may be screaming at their ghost out there who listened to it or screaming. Right, or screaming at their telephone, that's playing this podcast right now, or their computer screen. But I mean, I'm just saying, imagine what if there is a scenario where
the strait opens back up. And again, we could leave this podcast recording in 5 minutes and see that things been opened up and tankers are streaming through. Then what happens?
Yeah.
You could actually see oil come way down. If the energy shock has caused the inflation that we just experienced, right? So what's going to happen when that oil comes back on the market? You could see a completely
Reverse.
equal but opposite reaction, and you could see oil. And then what happens to the rest of the economy when oil and energy are really low? Now goods cost less to produce, trucking, all that other stuff. So don't lose sight of the fact that if this corrects, things could actually get better faster.
That it could.
Good.
Yeah. I think that's actually, like I said, we had 2 topics. So I think that kind of gives us an easy move into the next one, because you talked about what happens when oil comes down. You know, I think moving on to the second question, you know,
which is,
why has the market recovered so quickly? And why has volatility come down? But I think maybe more importantly, is this recovery sustainable?
Yeah.
And I think when I start thinking about that, you know, it's more, I think it is. Let me just start there. Like, I think it is sustainable. Meaning that this recovery is not something that could be quickly reversed. Markets go down 20% in a day. I think you've seen a lot of the pain already come in.
Right.
And I think a big reason why I do believe that is, you know, earnings. Let's talk about something that's not related to inflation, geopolitics, or anything like that. If you just look at, you know, earnings related kind of growth, they're pretty strong right now. Like S&P 500 earnings are still projected to be higher year over year. And again, stock market cares about earnings. There's no way around it.
Right.
That's why, you know, given whatever's going on, earnings matter.
Right. And let me just interject, which is why you cannot get caught up in your political belief system and try to overlay it onto a portfolio strategy. That's exactly why, because earnings don't care about whether you do or do not like a current administration.
Yeah.
They just don't. Companies are either making money and printing cash, or they're not. And that's it.
Yeah.
Like the dollar of profit that we generate as a small business or anybody else generates as a small or large business does not care about somebody's opinion about one administration or another. Sorry, sidebar.
No.
Sidebar over.
No, but I think that's important because, again, it sounds really binary, but it is that simple. Are the companies making money? Because a stock market, you're investing in those companies' success.
Right.
So if they're being successful and navigating environments, again, getting back to expectations, if they're meeting expectations, that's what the market wants. The market doesn't like the big surprises.
Right.
And I think, again, we've seen a lot of the big surprises happening. You know, it's really interesting to me because we're recording on the 20th. So April 20th, previously over the weekend, U.S. naval ships boarded, shot, basically took over a cargo ship from Iran.
Right.
And the market, as we're sitting here at 11:45, is down 0.4%. And to your point, oil is only up 5%. It's at $88.
Yeah.
So even in a situation where the ceasefire looks to be tenuous and is about to expire, the market's still hanging in there strong.
Yeah.
It's right near its all-time highs again. Why? Because people now are expecting and can build that into business plans, build that into kind of how they're thinking about the market and long-term growth. It gets back to expectations, just like inflation.
Right.
The market is an expectation vehicle.
Yeah. And so to put like some reality onto that, go back to January 1st of 2025. What if you did nothing during the drawdown of April of 2025? What if you did nothing, which most people with good investment strategies actually didn't do anything?
Yeah.
If they needed money, they lived out of their cash reserve. What if you did nothing? And then what if you've done nothing now? Where are you now? And so I just think that is very relevant, timely examples of the power of doing nothing, you know?
Yeah.
And I'm just going to, I want to dive into this more, but since I brought the politics thing up, have you ever seen, I know you've seen the charts, but to explain to people listening, that there are those charts that exist where it shows the stock market going up over 25 years and then shows you like the major headline of each kind of year, right? And it tend to be like disasters. Okay. So looking at one of those, I decided to go in and just kind of research just a few administration returns, right? So in the Trump 2025, right? So, I mean, the market dropped almost 20% during the tariff tantrum.
Liberation Day.
Right, okay, whatever you want, right. You know, investors who panicked, they locked in all those losses. The S&P finished up 18% last year. Okay. You go back to Trump election night, 2016. And by the way, for people who are already screaming, I'm going to talk about Democrats in a second. I'm just kind of going in like the order that I did this. You go back to 2016, the election night, the futures were down 5% overnight, just based on the election. Okay. Yeah. And then it kind of, if you remember back then, the markets hit limit down circuit breaker the night he won the election. Okay.
Meaning with circuit breaker, for those who don't, meaning the markets literally say, everyone stop trading.
Exactly.
Like,
right.
No,
this has gotten out of control.
Take a breath. And they literally shut down the markets.
Right.
And it happened in COVID a few times as well.
A couple times, right.
Yep.
And you have to go back to 1987 to understand why circuit breakers were invented. Okay.
Not conversation for today.
Exactly. Right. So what happened the next day? The market closed up. By the end of the next day. And by the end of 2017, the S&P returned 21%. So you went from a circuit breaker limit down to the market actually finishing up by the end of the day. So there's emotional reaction to political situation like in black and white.
Mm-hmm.
Go back to the Clinton impeachment of 1998, right? The House impeachment vote came down on December 19th of 1998. Okay, the S&P 500 finished the year up 30%. Okay, so the market didn't even blink over one of the most notable White House scandals that's taken place in the history of our country. Okay, we don't need to go into the whole scandal.
Do your own research.
Do your own research. Ronald Reagan, Iran-Contra. I know. Now, I was a teenager when this happened, so I had to go back and actually look up the statistics. And I didn't even remember it, but 1986. I mean, this was the largest presidential approval drop ever recorded in a single month. Dropped 21 points in a single month, Ronald Reagan with the Iran-Contra thing. The S&P finished up 20% that year.
It's impossible to predict.
Right.
This happens all the time. We say this all the time. And the most dangerous phrase in investing is this time is different.
Right.
You know how many times during this Iran conflict I've been hearing people say, well, this time is different.
Right.
It's tough. Tough to believe that when you look at all the historical examples there. And just it goes to show it. I mean, we say it, and I think we said it earlier in the year, 5% declines happen multiple times per year.
Right. Right.
And this one got to maybe down 9%. Well, a 10% decline happens once a year.
Yeah.
If you can't ride that out, why are you investing?
Right. Back to because I got us sidetracked. Because I didn't want to do the research and then not say it.
Sure.
Okay. So, a little bit of I didn't want to waste my time. So, but I thought it was interesting. But the question is, why has the market recovered? And honestly, I don't mean to sound flippant when I say this, but I'm not sure it really matters why. Right. Now, with that said, and the reason I say it doesn't really matter why is because investors should just be invested right for the long term.
Yeah.
Okay. So with that said, some statistics, because I like possibility versus probability. I like looking at what is the data said, what in the past. The 11.9% gain in the S&P 500 over the past 3 weeks was the 13th biggest 3-week gain since 1950. It was not an insignificant rally.
Yeah.
Okay. So what makes that unique? Okay. This is the only example of the top 20 of those where I say it was the 13th biggest, if you look at the 20 biggest 3-week gains in history. It's the only one that didn't happen during a bear market or after a bear market low. Just happened.
Yeah.
Not because you would expect to see those massive rallies when you're coming off the bottom of a bear market.
Correct. Down 20% or more.
Right. Like March 2029, or 2009, right? I mean, you expect to see these rallies off the bottom.
Mm-hmm.
We're not even in a bear market. And I mean, we were down 10%, let's call it ish. And it just, in 3 weeks, it just rallied. I mean, that's unique, I think. Here's some more stats. I'm just going to read these. The S&P 500 new high in April, full year up 8 when the S&P 500 has hit a new high in April. Okay. Again, past performance is not indicative of future performance. But when that's happened in April, S&P set a new high in April. The full year has been up. The next full year has been up 18 out of 19 times, on average 18.8%. So Dave Armstrong rounding 19%. Okay, that's not an insignificant statistic.
No.
When you talk about the number of times that that's happened. Okay, when the S&P 500 is on a 7-day winning streak, the full year is higher 19 out of 20 times. And again, 18.8% on average. So like things, you can't say, hey, the market's just had a rally, I want to sell. We're at an all-time high. We just had this rally. Maybe it's time to take some chips off the table. These statistics tell you that's not probably the best idea in the world because, again, 18 out of 19 times, 19 out of 20 times have been 18. Okay, I'm just saying that. Since 1928, this is the first time the S&P 500 has made a new all-time high within 11 trading days of a 5 to 10% drawdown. I think that's significant, right?
Yeah,
and
the speed of this has been impressive.
Here's my volley back over the net to you on this topic, which is like, okay, maybe what people should be considering right now is they're not bullish enough. I just kind of I lob it back over to you for that.
Oh, what do I do with that? I mean, I think you're right. Let me say you're right, but also here's the one reason I'll let you sell right now. And I think one reason you should sell right now. Mm-hmm. You have cash you know you're going to need in the next 12 to 18 months. To your point, you might not be selling at the all-time high because you're always going to hit another all-time high.
Sure.
So guess what, though? Get that money out now just in case you do have an event that, again, causes that volatility. Because even though we just survived a 5% decline, that doesn't mean we're not going to have one. Again, they happen multiple times a year. So even within all those statistics, 12 months out, you see a lot of strong performance from these kind of events. Mm-hmm. But if you need cash, do it now.
Right.
Don't do it when it was down 9%. Use that as a moment of, oh, hey, not a good time to raise cash. I need cash soon. Now I have the opportunity to.
Right.
But don't do it to try and time the market. Don't do it because you think, oh, I need to de-risk my portfolio here. Like, I got lucky that I didn't do something panicky at a 9% decline. Like, I'm going to do something still probably not indicative of a great plan right now. It doesn't, to your point, it almost doesn't matter why the market recovered. Like, I can give you the quick reasons. Inflation expectations came down because oil prices came down, and that means the Fed's going to cut. There you go. Yeah. That's why the market is recovering so quickly. Mm-hmm. It has nothing else to do outside of, I think, the positioning there. But that doesn't mean you don't have to do anything. Yeah. You have your cash bucket. Be ready for it. And understand that these volatility events are always going to happen. So make sure you're ready for them.
Yeah.
It's the most sage investment advice is a lot of the times you make more money sitting on your hands than tap dancing on your feet.
Right.
And you do that by staying invested.
Yeah.
It's not any more complicated than that. That's what makes people successful investors is managing your cash bucket, having a long-term strategy. I wish I could say some giant thing to make seem like we have complete insight or are going to predict. We're never going to predict these markets.
Right.
No reason to.
You made a really interesting comment earlier before we started recording about the Mag 7, and I wanted to give you an opportunity to like lay it down, as they say in the music industry.
Like Dean Martin would say.
Exactly right.
I think the comment I made earlier, and this is really important to know, is that yes, the market's recovered. It's just still a super concentrated market.
Yeah.
And what I mean by that is the companies, the Mag 7, Magnificent 7 companies, all those big tech names, the Apple, Amazon, we don't need to name them all, everyone knows, are still a huge piece of the index level. Mm-hmm. I think, and that's driving a lot of the index level growth because the Magnificent 7 companies are expected to have 22.8% earnings growth. Well, the other 493 companies are about 10%. Half that rate. Mm-hmm. So again, the whole recovery is based on, again, like we were saying right at the beginning, earnings, but being driven by a very concentrated few number of names is really where you're seeing a lot of that going forward.
Yeah.
I don't know if that's a healthy market. I can't make that level of a statement, but it's good to see all companies still have good earnings growth. And then in addition, again, that's why you stay invested.
Yeah.
is because, again, you believe that over time these companies will go through cycles and eventually the Mag 7 aren't going to have the same level of earnings growth.
Right.
It'll be the other troops supporting the generals, is the old saying.
Yeah. Right.
Well, I think then let's move on to, speaking of the Magnificent Seven, man, we're getting good segues today, I have to say, is our final and third question. And I think it's a little philosophical, but we can go any way you want with it. Dave, as AI continues to become more ingrained in every part of everyone's life, what is the impact on the economy?
Okay, so because small businesses drive so much of the economy and we are a small business, I'm going to focus on my thought there, right? Because I don't think that most small businesses are going to lose out to competitors just because of AI, right? I don't think that. And frankly, that may even apply to big businesses as well, but I want to stay on the small businesses for a second because I think small businesses are going to lose out to someone who just figured out AI 6 months earlier than their competitor did, right? I don't think that people are going to lose out because they perfected the use of the technology, right? No one's going to like put another small business out of business because they perfected the AI technology. I don't think they lose because they become fully automated by AI. It's as simple as this. I think small businesses will lose out to other competitors simply because the competitors just started using it while everyone else was sitting around just looking at it and trying to figure out how to use it, right? So I don't think that you have to perfect it. I think as a small business, you just have to start using it to maintain your competitive edge. I don't think this is binary like AI is going to put this industry out of business. I think there will always be small businesses that thrive and are profitable if they're using AI rather than just sitting around and looking at it and trying to figure out how to use it. It could even be an advantage to the small businesses over the bigger businesses because they're more nimble and they can adopt it faster. So like, for example, a small business like ours can adopt and start tinkering with and at least playing with it faster than a Fortune 500 company can because they're going to have study groups and
red tape,
right? All of that. And so the fact that smaller businesses can get a head start is huge. And the smaller businesses that get a head start over the other smaller businesses and they just start using it. They don't have to perfect it. They just have to start using it, I think, to start to figure out how they can leverage it and cut costs inside of their own. I don't know if it's going to like put something out of business.
I think the thing it will put out of business, though, is the entry-level job.
That's a good point.
So I think that's something that we all need to be aware of is it is a very difficult job market for people that are graduating from whether it's graduate school, undergraduate, high school. If you're going into an entry-level job, it used to be a way that you would learn a lot just because you'd be given all these remedial tasks that other people higher in the organization did before, but now have other higher priorities. Those are gone. Oh, they're quickly disappearing. I shouldn't say gone. That's a little bit too
It's harder to find an entry-level job. It just is.
You know, I've been talking with someone who said that they applied to 300 jobs in a 2-month span because they were just coming out of grad school. And they did 250 custom cover letters and resume kind of crafts. I mean, they ended up with a job, but if that's the amount of work that you had to do, and maybe I got lucky because I didn't have to do that many applications coming out, but that's the kind of effort it takes to get a job these days because so many companies are able to be, like you said, cut costs, be more efficient. It's no secret that hiring and your staff is the most expensive part of a business.
Right.
So how can you cut costs easily? Well, if you don't, maybe you only need 2 people to do a task that used to take 4 entry-level workers. There's 2 jobs gone there. So I think it's actually very interesting to see because Bloomberg put out an email over the weekend where they released or they talked about a study from Gallup. Gallup does a big polling company, and they looked at how is Gen Z, so people, let's say 14 to 29, think about AI. There was a huge change in the percentage of people in that age group that were excited or hopeful.
Yeah.
You want to know what emotions went up? Anger and anxiety.
Really?
And these are not just because, you know, the youth isn't using this kind of technology. You know, even people who said they used it daily, weekly, monthly, high percentage of them all are saying they are less excited about AI in the future. I think that's part of the reason is they're worried, I think, about, the lack of learning opportunities in the future in the real world, quote unquote, not through AI. So while it's a very good thing for business owners, and I think businesses overall, it'll help the economy.
Yeah.
Definitely will, because it's almost like a house. And we talked a little bit about on our quarterly update. When someone buys a house, there is this boom effect of all the services and everything around it. AI is going to require investment. It's going to require investment in infrastructure. It's going to require more jobs. There's whole towns that are being built around the data center because everyone needs to live around their data center. There's all these jobs that come in.
Right.
So it's going to provide a big boom in so many ways that I think a lot of people aren't even thinking about. My favorite is around fertilizer. John Deere, it now has technology. I think it's John Deere, has technology that can scan a field and with millimeter precision shoot fertilizer on weeds only.
God,
so you don't waste just spreading out a whole field. It's easier to do organic because you're not having to spray all the fields you're spraying around them.
Yeah.
That's not a human sitting there with a spray bottle,
or
pew,
a crop
pew, pew,
duster coming in, yeah.
Right? It's a literal computer that can do all this.
Yeah.
So there's all the improvements in the efficiency, but I do think it's really interesting that the Gen Z generation that's coming up is becoming much less excited and hopeful about it, which isn't normal for new technologies.
Right.
It's usually like, hey, boomer, like go do your technology, like, figure out how to use what I do. Like I can do a computer, and the older generations don't adopt it. Because that's just usually how technology works. When a new technology comes, it's usually the youth who start using it first, and then it bleeds up kind of the age chain.
Right.
I think it's the exact opposite. I think there's many people who are in an older generation that understand and are starting to use AI way more efficiently than the younger generations.
Right. I'll make up a scenario, okay, that's grounded in some sort of reality, right? So getting some statistics together to talk about the inflation part that I talked about earlier, right? In the old days, I'm using my air quotes for audio-only listeners, somebody at my level would have gone to a junior analyst and say, I need you to get me the bullet points on the latest inflation report. I need you to go back and look at the 25-year history of, what's been more than inflation, what's been less than inflation. I need you to look at wage growth over the past 25 years, all that stuff. And an analyst would have sat down, or the junior person on the team would have sat down and probably at 7 o'clock at night, working late, done that research for you to make sure that I walked in with bullet points about. So I just went in and researched it myself yesterday afternoon. And it took 10 minutes. Using Claude.
That's where all your tokens went. No,
exactly the problem. Right. That was yesterday though. But,
yeah.
No, but that's an example of, I'm a Gen Xer, so I'm not a boomer, but it's an example of somebody older using and not. So I'm like, okay, well, that analyst position doesn't exist at Monument because it's computerized now. It's AI'd.
Well, yeah, it's because with AI, someone at, again, your level can easily do that. Right. It's not as big of a time suck as it would have been before. Because again, time's valuable.
Yeah.
We say that all the time to our clients and to everyone that I talk to. You're not even just clients. Like, everyone, time is valuable. Everyone is so busy that ways that we can help.
Yeah.
That will go a long way. We just can't forget about the next generation.
Yeah.
Because even again, I saw it on the train down here. The person next to me is using AI not as a thinking tool or a research tool, but asking them how they should be feeling about certain events. And that's a really interesting thing to me. We can't lose critical thinking. And if we just totally abandon a generation, there's a chance of that, which is funny because I'm a millennial and I'm like, save the children from dangers of computers. But realistically, I think, again, it's going to help out the economy a lot.
Yeah.
But there is a population that is being kind of, hampered, I would say, by what we are able to do. So there are always trade-offs. It's never a win or a lose. But I think, again, it's, I don't think the robots are coming for us.
Right.
It's just something we're going to have to learn to deal with.
Yeah. Well, I think that was our 3 questions, right?
Yeah, no, that closes it all out. I mean, it's all we got today. And we always say this, if, you want your question answered in our next AMA segment, reach out to us. Leave a comment. You can send us an email at offthewall, all one word, at monumentwm.com. And as always, Dave, thank you for a great conversation.
Yeah, thanks. It was a good time and appreciate the time. I always appreciate the conversation. So until next time.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.